The thing I would point out is that there are bull markets and bear markets, and in basically any tradable instrument or commodity, or I consider gold to be a form of money. But what we're really talking about when we say, gold is up, what we're talking about the dollar price of gold. And I view it as a cross exchange rate. People talk about the dollar, the euro dollar exchange rate. Well, there's a dollar gold exchange rate, and that's the dollar price of gold. So they're just alternative forms of money where people get to express a liquidity preference or a credit preference, if you will, if you're concerned about if you're losing confidence in the dollar.
We will now bring you clips from the interview. Please watch, share, and like this video. Also, ensure you subscribe to the channel, turn on post notifications, and share your thoughts about the video in the comments section below. Thanks and enjoy the video. The renowned economist Jim Rickards continued her speech as follows.
But the first great bull market was 1971 to 1980. It lasted 9 years, and gold went up 2,200%. The second great bull market was from 1999 to 2011. Gold went up at just a little under 700%. But in between, you had a bear market from 1980 to 1999. So a long one, almost 20 years. Gold dropped from $800 to $250 at the bottom in 1999. And we had a second bear market starting in 2011. Now, I had a very interesting conversation with Jim Rogers. Jim is one of the great commodity traders, money managers of all times. And we were down in Dominican Republic at Casa de Campo. This is around 2014, but the bear market started in 2011, but it really fell off a cliff in 2013. So I said, Jim, what do you think of gold? What are you doing? He goes, well, I own it, of course. And he said, I'm not selling, but I'm not buying right here. And he said something that just hit me right between the eyes, and it stayed with me. And of course, he's right. He said, gold's going to the moon, but nothing goes to the moon without a 50% correction along the way. And if you look at the high in 2011, $1,900, approximately, and where was the bottom of the bear market? It was $1,050 on December 16, 2015. Nobody knew it was the bottom at the time. But if you look at that drop down and you use $250 as your base, because you need a base, so you had basically the run from 250 to 1900 was $1,750. Go down 50% from there, it's $825. 1900 minus 825 is 1075, and the bottom was 1050. So Jim totally stuck the landing. Like at 1050, okay, there's your 50% retracement. Now that's the bottom. Now it's going up, and the sky's the limit. Well, we're not overheated at all. I've got gold at I would put it at $15,000 an ounce before 2025. But as I point out, if you're going to $15,000 an ounce, you got to get to 3,000, 5,000, and 7,000 first. So there's plenty of room to run, plenty of room for profits. But when I say things like that, I want to be clear. There's a lot of analysis behind it. I don't just pull a big number out of the air and for publicity, because I could care less. But if you just took the average, there are a couple ways to think about it. Just take the average of the two prior bull markets I mentioned. So 71 to 80, 9 years, 2,200%. 99 to 2011, a 12-year bull market, about 700%. Just take the average. You don't have to go to the higher of the two or extrapolate. Just take the average of those two bull markets. You would say, okay, well, the next bull market is going to be a little over 10 years, and it's going to go up. It's going to go up 1,500%. So using that as your base, just take the average of the two. You say, all right, 10 years from 2015, that puts you out to 2025. And at 1,400%, it puts you at $15,000 an ounce off a 1050 base. So that's just history. But there are other ways to think about it. Now, I don't know if there'll be a gold standard or not, but I do know that gold will move, the price of gold will move in the direction of where it would need to be if you're going to have a gold standard. And I talked to Paul Volcker about this, and he agreed. If you just took the money supply, so just take M1, which is a pretty widely accepted definition of money supply. Take it for the U.S., the ECB, UK, Bank of Japan, and People's Bank of China. There are other entities you could include, but that's over 75% of global GDP right there.
The renowned economist Jim Rickards continued her speech as follows. Divide that figure by the official target, which is approximately 34,000 metric tons. Slightly less, you arrive at $115,000 per unit. So, well, If you intend to either reinstate the gold standard or even utilize gold as a monetary reference, if you want to restore faith in the dollar, the inferred non-deflationary value now stands at $115,000. What I discover to be intriguing is that whether you consider the historical data from the last two bull markets and average them or employ a meticulous calculation, what's the implied non-deflationary value? Interestingly, they converge at the same point. I don't believe they must, as they represent distinct methodologies, but both pinpoint $115,000 per unit within the next 3 or 4 years. It's a moving objective. The numbers I provided were based on present levels, but as you continue to print currency, you'll require a higher value to reference gold and prevent deflation, which they don't desire. You'll need a progressively greater gold price. One factor that people tend to overlook is, they frequently observe the dollar value in absolute terms, such as a $100 rise per unit, or, I anticipate it will escalate by $1,000 per unit weekly in the not-too-distant future. However, each dollar increase represents a smaller percentage gain. People observe the dollar value, which is actual money, a means of making money, but if you go from $114,000 per unit to $155,000 per unit, that's merely a 7% increase. That can be achieved within a week. So, my point is, it's still $1,000 per unit, advantageous for holders, but the percentage increase dwindles as the absolute dollar amount grows. Thus, $115,000 may seem significant from today's perspective, but as you progress to 10, 11, 12, it becomes a proportionally smaller percentage increase and, therefore, more probable. To truly comprehend it, you need to assess it logarithmically, visualizing a less hyperbolic trajectory. Logarithmically is the appropriate way to analyze it, but in dollar terms, the percentage increase is quite minimal at those levels. When I mention $155,000 now, I don't believe I'm stretching it. Could it be $25,000, $40,000? Just consider my monetary equivalence. If you apply M2, and, by the way, when I computed it with M1, it was at a 40% reserve, as historically 40% has been a substantial level of backing. If you consider M2 with full backing, you swiftly reach $50,000 per unit. I believe my figures are conservative. They could be much higher. Nevertheless, what I would emphasize is that the Federal Reserve has dug a hole, and they can't escape it. I have maintained this for quite some time, but particularly in 2014, 2015, etc. As they engaged in the taper and subsequently initiated the rate hike, raised rates, and so forth, I claimed that the Fed is attempting to normalize the balance sheet, normalize interest rates. However, I also asserted that they won't be able to achieve it, and that's precisely what transpired in the fourth quarter of 2018, between October 1st and December 24th, 2018. The stock market plummeted by 19%. It was on the brink of entering a bear market at that stage. Subsequently, the Christmas Eve crisis occurred, and that's when Jerome Powell surrendered. He had an epiphany. He said, "All right." Initially, he announced, "We won't raise rates any further." Then he stated, "We're on hold." Afterward, he declared, "We'll actually reduce rates." And subsequently, 9 months later, he proclaimed, "We're terminating quantitative tightening, which is the reduction of the money supply." Then, in September 2019, they instigated QE4, even before any recession, prior to the downturn, before the pandemic. They were already in QE4 and decreasing rates anew. Consequently, they can't extricate themselves now. It's deteriorated. They have unequivocally verified the failure. They have demonstrated that they can't emerge from it. And what alternatives do they possess? By the way, regarding monetary theory, they ask, what's the hidden principle behind MMT? I consider it to be nonsense, incidentally. So, what's the underlying concept? The underlying concept is that if you can issue debt and gather taxes in a currency that you print, you can compel people to embrace the currency because they require it to settle their taxes. If they don't pay their taxes, they risk incarceration. Of course, you can request extensions or take other measures, but ultimately, if you categorically refuse to remit your taxes, they will apprehend you and place you behind bars. The point is that it depends on state authority. It's fundamentally a neo-fascist notion. It relies on coercion, the threat of force, imprisonment, and state authority to ensure faith in the currency. Now, that's what they assert, and I've examined Stephanie Kelton. She's the prominent figure. This goes back quite a long way, but I've met her, studied her book and her essays. However, they're remarkably direct about it. Now, I believe it's completely flawed because there are numerous workarounds, various methods to evade that type of state authority, but ultimately, it hinges on state authority. That's why I perceive it as having a neo-fascist component.
Don't forget to like our video and subscribe for our channel.